Major support for Carolina Business Review provided by Grant Thornton. Operating in more than 100 countries, our tax, audit, and advisory professionals specialize in helping companies unlock their growth potential. Colonial Life, providing benefits to employees to help them protect their family, their finances, and their futures. High Point University, the premier life skills university, focused on preparing students for the world as it is going to be. And Sonoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services with more than 300 operations in 35 countries.
PayPal, Venmo, Zelle, cryptocurrency, blockchain, cybersecurity, AI. These are all very important parts of fintech. Welcome again to the most widely watched source of Carolina business policy and public affairs. I'm Chris William. Thank you for supporting this dialogue. Fintech is shorthand for describing the dramatic growth of an industry known as financial technology. In other words, it relates directly to innovation in financial services. Some call it shadow banking. We will unpack it, what it is, how it's growing, and what its impact is in the Carolinas. And we start right now.
Gratefully acknowledging support by Martin Marietta, a leading provider of natural resource-based building materials, providing the foundation upon which our communities improve and grow. Blue Cross Blue Shield of South Carolina, an independent licensee of the Blue Cross and Blue Shield Association. Visit us at southcarolinablues.com. The Duke Endowment, a private foundation enriching communities in the Carolinas through higher education, healthcare, rural churches, and children's services. Barings, a leading global asset management firm dedicated to meeting the evolving investment and capital needs of its clients. Learn more at barings.com. On this edition of Carolina Business Review, Chris Cox of Apiture, Dan Roselli from Queen City Fintech, Jillian Munro of Spreedly, and Dan Drees from AvidXChange.
Welcome again to our program, FinTech. So, Jillian, I'll start with you. I mean, it's a dope-sounding name, but what is FinTech really?
Well, I mean, so definitionally, obviously, I mean, you already said it is financial technology. But I think when I think about it, I think more of it as terms of themes and concepts around it. It's innovation. It's digital. It is taking, filling holes and gaps that we don't have in the industry. From traditionally from kind of the big sources, and it's pushing the envelope. It's total disruption.
So Dan, Queen City Fintech, of course, in Charlotte, but also Carolina Fintech. Well, is it because the banks have not been able to the regulatory process be nimble enough to invest in fintech? Is that why this sprouted?
Yeah, the entrepreneurial community has the advantage of being able to move really quickly, to fail fast, to iterate through that. And the nice part for the big companies is if something goes wrong, it's outside their firewall. They don't have to worry about the ramifications of something blowing up. And I think the big financial institutions have realized that staying close to that disruption is really better than pretending it doesn't exist.
Yeah. Chris, Dan, please.
Yeah, I mean, I would add, I think a lot of times people use the term fintech to draw a distinction between modern technology companies who enable financial services and traditional providers of financial services like banks and credit unions. But it's really getting harder and harder to make that distinction. Banks, to compete and survive in today's market, really have to be fintechs. So you're seeing, a lot of banks actually start to refer to themselves as fintechs because they need to compete.
Well, and that's the natural progression, though, isn't it? That the arbitrage between what fintech is and what big banks are, that gap gets smaller and smaller.
Yeah, I love what you said, Chris. I just add the one word that keeps coming to my mind is software. At the center of all this is software, and the other big word would be speed. So I think, Dan, you said that the fact that we can go faster and help banks meet this new need, the needs of their consumers, which is just, their expectations are so high. They're used to these consumer experiences that are just magical, and for institutions to move really fast and catch up with that, you got to have help, and that's kind of where I think fintech kind of comes in.
Does the success of fintech start to draw some but increased scrutiny from the regulatory bodies, like the Fed, like the U.S. government, like Basel II, et cetera, et cetera?
Yeah, so it's interesting. A lot of the regulators from Washington, they will come and do roadshows now. So they've understood this just like the big financial services companies have. They come and they'll do office hours with our startups that we bring to Charlotte because they say, we want to help you figure out the regulatory landscape. We want to make sure you don't step on landmines as you're innovating. So they've done a pretty good job of collaborating, more than you would think.
How do some of your old colleagues at Fidelity, JP Morgan, do they look at this as an oppositional, or do they look at this as, so fintech competes with us, or they put their arms around it?
I think it's a little bit of both. So it's one, how do big companies make that leap into fintech? And that's, kind of where you have a lot of cultural challenges, some talent challenges, and some regulatory challenges because there are a lot of more obligations from a big company standpoint. But at the same time, it's great opportunity for companies to work with smaller companies, to embrace them, to partner with them, maybe even to purchase them and bring them into their estate as a product and kind of catapult their own product set.
In my experience, the regulators understand where financial services are going in terms of new technology. My company, for example, provides services to banks and credit unions. So we're actually examined every year by the FFIEC, and they're looking at us to help them understand what are the regulatory impacts of these new technologies, like the cloud, like open APIs. And I think the relatively...
And tell us what an API is for people that don't.
Yeah, it's an acronym, Application Programming Interface. It's sort of shorthand for ease of integration between disparate information systems. That's what it is. So an easy way to connect different software services.
So AvidXChange would be an API?
We have APIs. We leverage APIs to connect with banks and our customers in really fast, simple ways. Yes.
Yeah. And Spreedly does as well, right? We are an API to payment processors.
Yeah. Yeah, I think at AvidXChange, Dan, obviously you're deep in the DNA with AvidXChange, Mike Prager, et cetera, et cetera. Do you feel the scrutiny, eventually the heat and light will be shown from the regulators on AvidXChange and like companies? Will that eventually happen?
Well, actually, I think about it a little bit differently. I think in the early days of fintech, I think companies got a little bit of cold water when they first realized all of the compliance they had to figure it out. At this stage of the game, when you've got companies like AvidXChange and others that have kind of figured out that that's important, frankly, have cross-pollinated bank talent into these companies, and people get it, you actually have the opportunity to build compliance in to the base platform. And in a way...
Almost self-policing?
Well, I wouldn't say self-policing, but I would say it's almost if you have a blank sheet of paper, you're able to design compliance into your platform in ways that maybe is harder for a bank that has lots of legacy tech to do. Mm-hmm. And so I think as long as the firm is kind of graduated past those early days of like understanding what compliance means in financial services, you can design that in and actually be even more nimble. And in some cases, you can be more secure because you're able to use the latest tech with a blank sheet of paper and new designs.
And Chris, let me build on Dan's point, because it's true in the entrepreneurial space. Charlotte and North Carolina is so deep on regulatory and compliance experts. That's a lot of reasons why young fintech companies will come here, is they know we have that expertise.
That's a resource. That's
it's a
not
competitive
a
advantage, absolutely. And a matter of fact, I think they see it that way. And to Dan's point, build that in from the beginning, especially international companies that are looking to come into the U.S. marketplace. They see Charlotte and North Carolina as one of the best places to land because that expertise is here.
So does the money flow to the Carolinas then because of this momentum that's being built? Does it flow to Wake County, the Triangle? Is it flowing down New Hanover County? Who would have guessed that Wilmington would be a center for this?
That's right. We've got an emerging fintech scene in Wilmington, North Carolina, built around Live Oak Bank and companies like Apiture and Encino. And the money does come, right? I think this state, with the banking center in Charlotte, technology center in Raleigh, and startups popping up all around the state.
Dig South, Charleston. I mean, don't those help?
It absolutely does, and a spin-off from some of the founders at Live Oak, a venture fund called Canopy, is going to be one of the largest fintech venture funds in the country. And so yes, the money does flow. Packard Place, the entrepreneurship center we started, over $2 billion in venture capital raised, most of that from fintech companies.
Is it still early days? would you guess, when it comes to funding and development of fintech in the Carolinas?
I think it probably is. I mean, I think, we've got, a couple of unicorns in the state, which is really fantastic, and we've got a bunch in sort of the tween stage. But there is a lot of funding coming, and I think it is it is a very, very attractive place for fintech companies as well as venture capital funders to come. Just because of all of the amazing things that we have, right? Between all the big companies that help, kind of drive thoughts and talent from the universities. And kind of that, scrappy startup culture that we have with things like the American Underground and such. I think it's a very attractive place.
I think it's just starting. I think the idea that there's probably some exits in the near future, and what that does to turn
like AvidXChange,
perhaps turning those dollars over and getting them back into the ecosystem to then germinate new ones. And remember, it's the people who have that gene, that startup gene, that end up on an exit, putting that money back into new ideas. And I think we're early innings on all of that.
And this is not to press you on this, Dan, because I know you can't talk about this, and you wouldn't talk about this, but AvidXChange is a perfect example of that. So whether AvidXChange does an exit through the public capital markets or not, an exit for a company that we'll call a unicorn, $1 billion plus, just organically grown. Pendo's another one up in the triangle, and I can think of a bunch of them. But the point is this: does an exit benefit more than just the shareholders in the original deal?
Absolutely. It benefits every location that company functions in, and it creates new startups. It creates new ideas. So absolutely.
And it benefits in a couple other ways. Early on, the early investors in AvidXChange from Charlotte, Angel Partners, one of the very first angel funds, are going to have a nice exit. So angels in Charlotte and the Carolinas making money on unicorns is important. That's how people talk about at dinner parties. And even the venture fund that we're doing, most of the people are entrepreneurs who have had exits and built companies, and now they're investing back in the community through funds.
How easy is it to raise funds now?
Well, that's really hard. It's
you
always
just made
hard.
it sound like it was wind at your back.
It is, and I think our community is doing really well. But the reality is most the early stage companies aren't going to get funded. And it's interesting, with AvidXChange has been helpful for us in what we do, because when they raised their $250 million D round from Bain about 6-7 years ago, we could point to AvidXChange and say that we're planting seeds that are going to grow up and look exactly like that. But even in Charlotte, $250 million, people kind of yawned at it. It was the 7th largest fintech venture funding in the world, and people kind of yawned.
How does that kind of wash over you, Chris, when you hear him talking about the numbers?
Well, I mean, it's important, right? There is a lot of capital in this economy chasing good ideas.
Yeah.
But there are also a lot of good ideas, right? We're at, especially in financial services and fintech, we're at an inflection point, right? Right now, there is so much opportunity to provide better financial services to consumers and businesses. So the right ideas are going to get funded in this economy, and there's capital out there to fund them.
Is it, again, this question is going to sound pretty pedestrian, but is it easy to raise the money?
It's never easy to raise money.
Well, but as you just said, though, and I don't even want to repeat this, but the wind's at your back, 11th year of an economy, a lot of private dollars looking for a place to go for any kind of yield.
Right.
Venture capital money's got to be looking for the same thing. So is it, okay, well, let me ask you this way, Chris.
Right.
If the economy slows down, would it be exponentially harder to get some of the deals funded?
Well, yes. I mean, there's obviously a correlation between the economy and availability of funding. So it's relatively easier in this economy to raise funds than it was in 2008, as an example. But still, investors are smart. They're looking for good ideas. They're looking for good management teams, solid business plans. So it's never easy to raise money, but it's relatively easier in this market.
What's the biggest risk? We're talking about funding. We're talking about a slow economy to some degree. But what do you think the biggest risk is right now for fintech?
Cybersecurity.
Really?
Yeah, absolutely.
Someone said on a panel last week that I was involved with that cybersecurity is no longer an issue of when it's going to happen, but if it's going to happen, but when. So now people are starting to think, Jillian, that we're not going to be able to prevent it. So what's our remediation for it? Yeah. And is that an accurate way to describe it?
Oh, without a doubt. I mean, there's attacks every single day. It is not, and everybody has to be right 100% of the time. The bad guys just need to be right once, and then you've got an attack. So I think the bigger challenge in cybersecurity is if you think about all of the big banks, they've spent a ton of money on this, and they are doing a really great job. They've got organizations that are hundreds, thousands deep. And they've solved a lot of these problems, but they've also sucked up a lot of the talent. And they've also driven the value of the talent up considerably. So it's hard for startup companies to have the funding to be able to compete with the salaries that the big banks are paying for cybersecurity talent. But the interesting part of that is that it's also creating a secondary market, a secondary set of startups around cybersecurity that are now focusing on small to medium-sized businesses that do things like pen testing and red team testing as a service, consulting. You can rent a CISO. The other thing that the startups have.
You've thought about this a little bit.
I've spent some time in this space.
A few sleepless nights, maybe.
Yeah, perhaps. But part of the other part of this is that the fintechs do have an advantage in that, and I think you touched on this, is that a lot of them aren't built on legacy, and complexity is what causes complexity and variability is what causes a lot of.
So having to design or redesign something from organically,
right,
and not on the back of
Yeah,
something.
you build it up with security in mind, just as you talked about building it up with compliance in mind. You're building a secure product from the start.
There's some interesting things happening in the early space. I think IBM runs their global hyper-protect accelerator out of Charlotte, and that's data security in the web for young fintech and health tech companies. So you're seeing big companies bring their resources to bear so that it can be built the right way from the start. That's really exciting stuff. That's happening here in the Carolinas.
I agree. This is one of the most important concerns. And when it comes down to it,
cybersecurity is
cybersecurity. I mean, fintech, when it comes down to it, is about people's money. So all the providers in the space have to be super vigilant about protecting people's money. I think this is an area, to your point, Jillian, where traditional financial institutions may have an advantage, right? Going back, the history of banking, bank business models are built on two things: trust and convenience. Both of those things, those ideas are evolving in today's digital world. But the part about trust, that means any provider supporting banks themselves, or providing financial services needs to really focus on protecting consumer data. And you do that by having a comprehensive data protection program, which means you've identified data that's at risk, you've got layers of controls around protecting that data, you're audited and examined, and if there happens to be an incident, which to your point there probably will be, you've got an appropriate remediation or response plan in place. Yeah. So fintechs, even the smallest ones, if they're dealing with people's money, all of that is important. They can't deprioritize those sorts of things.
So let me ask you this way, Chris. To call fintech a shadow banking system almost as oppositional and would not be accurate?
I don't think that's accurate. I'm curious what you think, but a lot of the fintechs at the foundation are still using traditional banking products. Yeah. And a lot of times they're doing it in partnership with traditional banks. So, you can think about bank fintech partnerships as a way for banks to expand the set of services they offer to their customers. But at the foundation, it's really still traditional banking products that are driving what's happening in fintech, in my opinion.
Yeah, I would agree. I mean, even today, the payment process is still underpinned by a banking process. Those are bank rails. So I think about fintech's role as being more of helping the endpoints just function better and integrating the different components.
It's a lot of the end user experience getting better, not the behind the scenes infrastructure, which they're still riding on.
Yeah, and making it more efficient, right? Making it more accessible to the small merchants that are, kind of building up their digital presence. The market's 3 trillion transactions last year, or $3 trillion
globally
in transactions globally on online transactions. It's huge, right? And I think 46% of Americans have used their phone for transactions or they admit to using their phones to transact over the past year. So it's really, we are really moving to a digital state, and I think a lot of, and to your point, right? I think it's fintech is very complementary to the existing, banking system. And it's filling gaps. It's making it a little bit more efficient. It's bringing, lower cost options.
I agree. And to your point, Dan, we have reached a point where the underlying infrastructure also needs to evolve.
Yeah.
So, and one of the things that I think
regulatory or central banks or what?
The core infrastructure that individual financial institutions use, the technology infrastructure they use to run their banks, a lot of it is decades old. Mm-hmm. And that's fundamentally what's preventing traditional financial institutions, banks and credit unions from competing with fintech. So these banks, they're feeling pressure from a number of different areas, but one thing is, down to the point you made earlier, consumers have different and evolving expectations around how they want to interact with all businesses, mm-hmm. including banks and credit unions through digital channels. So in today's market, banks compete through digital channels. That's where they find customers, and that's how they service their customers.
Okay, so that's, and this is not to be oppositional, Chris, but that's got to be done in the full view of regulatory as well as policy. Banks can't do that quickly or nimbly because of the 4 or 5 different agencies that they have to report to. So how does that end up changing? How do you see banks becoming more flexible and compliant to a new system underpinning of exchanges?
Well, banks can evolve their technology infrastructure or modernize their technology infrastructure
outside of the auditing process of the Fed or the central bank?
They can, in a regulatory compliant way. So their examiners are going to want to understand what they're doing. They're still required to have vendor compliance programs and understand the new vendors who might be supporting their new technology infrastructure. They need to do that in a compliant way. But in my opinion, it's not really the regulations that's holding back innovation. It really is the technology that's holding back innovation at banks. They need, if you look at fintechs, a lot of times what they're doing is taking little pieces of the traditional banking value chain, and they're almost always doing it better than banks can themselves because they're focused on a specific use case and because it's modern technology. So banks need to figure out a way to get into that same dynamic.
Do you see that the holdback is the bank's technology and not the regulation, the oversight?
Yeah, and I don't know if it's a holdback. I think it slows them down. Like so we partner with directly with about 30 banks right now, and so we're literally connecting wires with banks to facilitate transactions and customer information. And so we kind of have seen, and I know Chris, you probably have too, we've kind of seen the gamut of technology infrastructure from brand new and works really good and we integrate in days, weeks, and then man, this is a 1-year project. And so it's a mixed bag out there, but it definitely prevents them from moving as nimbly as they would like to.
Yeah. Dan, who's doing it well? What bank? Not to play favorites, but who's out there?
Maybe you give shout outs? Oh, Lord.
Well, this is your opportunity to shout out.
It's interesting. I think the North Carolina community has done a really good job. And our sponsor, we've made a purposeful point to have a really wide table. So it's B of A, it's Wells, it's Ally, it's Truist, AIG, Aflac. I think all of them have realized the importance of trying to make this happen. And so I think they're all trying to do it really well. I know it's a political answer, sorry.
No, I think it's a thoughtful answer. Jillian, what do you think? Who's doing it well? Who's got it right? And maybe it's not a bank. Maybe there's some associated third party or related bank that does it really well. Who do you think has it right?
So I'm not sure who has it right. I know I think the banks are so large that I think it's being done right in pockets in almost every bank.
Beta testing within the organization, you think?
Yeah, there's some of that. There's some of, sort of labs type work. There's, one of the trends now is to create, sort of fintechs within large companies. The success, and one of the models is to spin off those fintechs into their own entity to pull them away from the corporate culture and the corporate management structure and processes to try to simulate some of the freedom that fintechs generally have to begin with. But I think it's being done well in pockets. I think the constraints of the environments really do bog some areas down, right? Where you have to deal with a mainframe, you're going to get bogged down.
And you said this before, and we've got a minute left. And Dan, I want you to answer this question. We talked a little bit about those things that bog it down, hold it back. Talent's got to be one of them. Is talent the biggest thing?
Yeah,
Finding talent?
When you asked the question before about risk, although it's super hard to argue with the fact that cybersecurity would be number one on the list, I think the thing that, maybe not as a risk, but a thing that slows fintech down is absolutely talent. The appetite for software engineers and architects is just
Insatiable, would you
the
call it?
demand is just way outstripping supply right now, and that's really the kind of the mini war that's happening in certain ecosystems. And as Charlotte and as Raleigh and as I know all these other areas are growing and developing, that becomes one of the things that's just top of mind for me.
Okay, thank you. Dan, thanks for being on the program. Jillian, good to have you on the program. Thanks for traveling from the Triangle.
Thank you.
I know
Thanks
that's not a
for
small
having me.
commitment. Chris, you came in from New Hanover County. Dan, thank you for helping us get our gang together and being patient with us while we tried to figure out how we were going to do it. Thank you for watching our program. If you have any questions or comments about this, we hope you'll watch the full length, but if not, CarolinaBusinessReview.org. Until next week, I am Chris William. Hope your business and your weekend are good. Good night.
Major funding for Carolina Business Review provided by High Point University, Martin Marietta, Colonial Life, the Duke Endowment, Barings, Grant Thornton, Sonoco, Blue Cross Blue Shield of South Carolina, and by viewers like you. Thank you. Promotional consideration provided by Business North Carolina Magazine. For more information, visit CarolinaBusinessReview.org.